Think your Singapore HQ shields you from Chinese regulators? Meta just lost $2 billion, proving the opposite. Okay, let's dive right into this explainer and unpack a massive regulatory earthquake that just literally shook the global tech world. We are looking at a landmark intervention by China's NDRC regarding Meta's attempt to buy out the AI startup Manus. You know, for decades, the global tech playbook was incredibly simple. Capital and talent, highly mobile. If a startup has roots in a heavily regulated market, no problem. You just restructure it, move the headquarters to a neutral, business-friendly hub like Singapore, and acquire it there. Clean, simple, completely safe, right? Yeah, well, entirely wrong. Meta just lost a staggering $2 billion, proving that assumption is completely dead. They thought they had safely acquired a Singaporean company. But Beijing stepped in and essentially said, not so fast, that technology actually belongs to us. I mean, this is a multi-billion-dollar forced reversal that completely rewrites the rules of global M&A. So welcome to the new legal reality. It's this concept called technological nationality. The PRC government is essentially asserting that it doesn't matter where your legal corporate shell is registered. What actually matters is where the code was written and who wrote it. That creates a permanent jurisdictional tether. And this totally shatters that old Silicon Valley mantra that code has no borders. As far as the NDRC is concerned, code absolutely has a passport. The jurisdiction is based on where the code was written, not where the firm happens to be registered today. Meta was really banking on what regulators are now calling Singapore washing. They bought a newly formed Singaporean entity called Butterfly Effect to shield the deal. But the NDRC, they looked right through that legal paperwork. Because the foundational R&D for Manus happened in Beijing and Wuhan between 2022 and 2025, they decided that underlying code holds a permanent Chinese passport. But why target this specific startup? Well, Manus wasn't just some basic chatbot. It was categorized as a general AI agent capable of autonomous reasoning. And in the PRC's eyes, AI at this level is treated as critical national infrastructure. There's actually a fascinating Chinese policy shorthand for this, avoiding selling young crops. It's basically botanical sovereignty. The state will not let homegrown emerging technologies get sold offshore before they mature to serve domestic interests. If it grew in local soil, you can't just uproot it. Okay, so moving on, this brings us to a second major misconception. A lot of global investors just assume that if you accidentally trigger a regulatory net, the worst-case scenario is you pay a hefty fine, maybe adjust some board seats, and just move on with business. But the NDRC doesn't just fine you. They force a total, agonizing unmerger. Under their security review measures, they issue what's called an order to rescind. And guys, it's not a polite request to restructure, it's an absolute mandate to unwind IP, fire staff, and return capital. They demand you restore everything to exactly how it was before Meta spent a single dime. Just think about the immense technical debt and financial friction of a forced post-completion divestiture. Meta had already started integrating. So, step one, they literally have to wipe the meniscus IP out of their ads manager, essentially funding a highly expensive cleanroom reconstruction. Step two, terminate the 100 employees they already relocated to Singapore. And step three, try reversing a $2 billion transaction across borders through China's famously strict safe currency controls. It is an absolute logistical nightmare. Which brings us to the ultimate shock for Western lawyers, the belief that an administrative block can simply be appealed to a judge. Usually, when billion-dollar deals get blocked, companies just lawyer up and head straight to the courtroom. Not here. There is literally no court to save you. This is a state of legal nullity with absolute finality. As Article 35 of the Foreign Investment Law clearly states, national security review decisions are final. They cannot be appealed to an administrative body, and they certainly cannot be appealed in Chinese courts. The state's decision is the final word. End of story. So Meta essentially has no choice but to comply, right? Because ignoring the veto risks their entire commercial presence in the world's second largest economy. Refusal to unwind the deal could land Meta on the unreliable entity list, which would bar them from trade entirely. Worse, regulators can use look-through provisions to target local assets, data centers, or even place travel bans on executives. The leverage the state holds is just overwhelming. So, the bottom line? The era of Singapore washing is definitively dead. Changing your legal address no longer severs your technological roots. You absolutely cannot just wrap Chinese-originated critical tech in a foreign legal shell and expect to bypass national security. It just doesn't work anymore.
This leaves us with a huge, critical question for the future of global tech M&A. As the geopolitical AI war escalates and artificial intelligence is viewed through the lens of national survival, is any cross-border acquisition truly safe? If code has a passport, border control just became the most important part of your entire investment strategy.
I've shared more practical insights on my LinkedIn. You can find me here. www.linkedin.com/in/rongqing Jiang 824282169. The landscape of cross-border acquisitions has fundamentally changed, and staying informed is absolutely crucial right now. Thanks for joining me in this explainer, and I'll catch you on the next one.